Welcome to Livewire's Buy, Hold, Sell. My name is James Gruber and I'm Equity Market Strategist at CommSec, and this is a bumper reporting season episode. The dust is settling on the February reporting season, where on the surface the ASX 200 inched higher, but that covered some wild moves. Just this week, Woolworths, a safe and predictable company, jumped 13% on results, while Zip the other week crashed 34% on weaker than expected earnings. I'm joined by Dushko Bajic from First Sentier Investors and David Lloyd from Ausbil to talk through the highs and lows of a busy month. This episode will be a bit longer than usual, and we'll be covering some of the key lessons as well as looking at some of the standout and flameout results across the market. So get comfy and let's get into it. First question, what was the insight you picked up from the reporting season that you think is important for investors as we move into 2026? I'll go to you, Dushko.
Thanks, James. Yeah, look, I think it's at the surface an uneventful reporting season and net upgrades. But when you look beneath the waterline, there's a lot of churn that's happening. Generally speaking, though, very positive reporting season. We've had bank credit growth between 7 and 8%, which has been good. We've also had the banks report very solid profit growth. But then when you look at the retailers, sort of mid-single digit sales growth, so economy's going along very well. But there's a big mix change within that. Very value conscious consumer. So if you're not on sale, the sales really tail off. So if you look at really good retailers like Nick Scali and JB Hi-Fi, mid-single digit sales through the half, but then January really ticked down to 2 to 3% sales because there's no sales event. And there's a really big skew towards Black Friday and Christmas sales. So if you're not on your game in terms of sharp price, the consumer's walking away. And I think the ultimate example of that was Domino's. Australian sales down 9.5% because they've backed away from their discounting strategies. So it's a real reminder to companies to stay on your game. And if you look at the Wesfarmers suite of retailers in terms of Bunnings, Officeworks and Kmart, they're really refocusing their portfolios towards providing a sharp price for their consumers.
What about you, David? Your thoughts?
Yeah, look, I agree with a lot of what Dushko said there, but I think what I have noticed through reporting season is that the dominant franchises are continuing to plough through this market environment. Pick your sector, CBA in banks has done very well, Woolies in supermarkets has done well, Hub in platforms continues to go from strength to strength, Charter Hall in REITs. So I am sort of finding that those dominant franchises are performing very, very strongly. It's probably not a surprise they've got very good management teams. Probably the dominant might be becoming a little bit more dominant in this market, I think, and I think they will continue to be supported.
We'll stick with you, David. How did companies report versus your own expectations, and have you made any portfolio changes as a result?
Yeah, look, on the whole, I think met our expectations. There's been one or two that have been slightly below, and you brought up Zip before, missed by not much. It's growing very quickly. Market was or is concerned about bad debts. It is a stock that we hold, but with one or two exceptions like that, it's been a pretty good reporting season, I would say. It's just that the mistakes, if you like, or the misses, and so that does have an impact on performance. But as far as portfolio changes, really not that much at this point in time, but we are looking to potentially use this as an opportunity to high grade the portfolio when you do see some really good quality stocks start to get sold off on particularly some of those AI concerns, and I'm sure we'll get to that soon.
Do you agree with that quality focus, Dushko?
Yeah, I mean, quality hasn't done very well as a factor, neither has growth. But in terms of reporting season, I think it's been a good reporting season. Like I said, banks kicked it off. NAB and CBA, 10% earnings growth, no bad debts anywhere in sight, really pristine credit quality. And then a couple of the other standouts have been the platform stocks. When you look at Hub and Netwealth, outstanding stocks, EPS upgrades, strong share price reactions on the day. 60% EPS growth by Hub. I'm sure we'll talk about it later on. Lots of operating leverage there. But then there's also a couple of disappointments. You sort of have a look at Cochlear, for example. That's its fourth consecutive half of missing earnings expectations. NPAT went backwards 10%, even though tax rate was lower, and that was 4% worse than market expectations. So they're really sort of trying to find their feet in the post-COVID time period. And with the new products coming on board. And then also Reliance, not a stock we own, just sort of interested to have a look at it. but again missed its earnings forecasts. It feels like they don't have much visibility within their own business, so it's hard to get a handle on what the earnings and the cash flows are going to be. But then slightly more concerningly, they're really getting crunched by $6 a pound copper, copper being what they make the shark bite product out of. They've moved their manufacturing from China to Southeast Asia. The Aussie manufacturing has gone to the US. They're doing everything they can, so good management team. But they've got to the point where they're even thinking about whether shark bite will be made out of copper in the future. And if shark bite's made out of polymer, is it really shark bite? So a few little clouds on the horizon there.
I want to talk tech stocks now. They've been under close scrutiny, obviously. Do you think the fear is justified, or is this an opportunity and there's value there? I'll go to you, Dushko.
So does it deserve scrutiny? Yes. Is it an opportunity and is there value? Absolutely. And the reason being is, we've moved from, clickbait ruling social media to clickbait ruling share prices. So there's a daily X post about the impending doom coming from AI onto SaaS, software as a service, or SaaS apocalypse as it's now called, that we've all lived through. When you have a think about it, lots of great functions in terms of coding, lots of efficiency to be had there in the hands of experienced software engineers. So efficiency to be had there, but does it really impact businesses with a strong moat in terms of data and functions that need 100% accuracy? Because SaaS software is deterministic. It's 100% correct and gives you the same result every time. And there are just so many functions where 90% isn't good enough. And AI is probabilistic. It gives you the most likely answer, but not necessarily the right answer. So if you've got data that's a system of record, or it's healthcare data, or there's a lot of regulation, 90% isn't good enough. And in fact, it's a tool. And what we saw, including from yesterday's Anthropic presentation, is AI is alongside software rather than in place of software. Uncertainty is fair, and some fall in terminal PEs is fair because there is uncertainty. But the market switched to certainty of absolute disruption in its pricing, and that creates an opportunity.
Do you agree with that, David? Opportunity?
Yeah, I agree with almost everything I think Dushko said there, made some very good points. I'd probably just add, I think there's a little bit of a view in the market that the incumbents or the SaaS players are doing absolutely nothing about AI at the moment, and that they're so far behind the eight ball. But I just don't think that is necessarily the case. I mean, they've got software engineers that have been writing code for their businesses since day one. These guys are typically on the cutting edge or the frontier of what is possible in AI and coding. So when you've got a very solid revenue base and a cost base, you're in the best possible position, I think, to exploit the benefits and potentially extend your lead in your market. There might be some pricing adjustments for product, and the ability to ratchet price at double digit every year might be at the margin coming down a little bit, but I still see these businesses being very strong. And to Dushko's point, if there is a strong moat, I think these businesses will continue to go quite well. So we think there is a lot of opportunity out there at the moment. Both
of you sit through hundreds of earnings calls. Is there one quote or message from a CEO that really caught your attention, David?
I wouldn't say as a quote. They all sort of blend into one another, but what really stood out to me this reporting season was just the confidence coming through from the lithium miners this time around. Certainly in a different position now than what they were 6 and 12 months ago. The market for lithium, it's a relatively small market, so small changes to supply in particular can have big impacts on price. But that market's going from an oversupplied market to what we think is a market in equilibrium to an undersupplied market. That's having a positive impact on price. But what might be slightly overlooked is during that last downturn, those lithium miners really had to cut back costs quite aggressively. So they have put their businesses in a very strong position to get a lot of operating leverage as prices start to recover. So I think that was probably the highlight for me, is just the confidence in the outlook for lithium stocks over the next 12 to 18 months.
What about for you, Dushko?
Yeah, look, we had a great one-on-one with Sam Huppert, the co-founder of Medicus, and one of the anecdotes he shared with us in the meeting was the fact that back in 2016, Nobel laureate Geoffrey Hinton predicted that there'd be no more, it's obvious that there should be no more radiologists because they'll all be replaced within 5 years because of AI's capability. And he just made note that he created a shortage of radiologists because a lot of fine young doctors chose another field, and Pro Medicus is now creating a lot of productivity uplift in its product to address that shortage and uplift productivity by 25% in terms of those scanned images. And when you look at what Mayo Clinic has done since 2016, they've actually increased their number of radiologists by 55%, up to 400 plus radiologists. So you can get a lot of big, bold predictions from a lot of smart people, but you're only looking at one part of the equation and you're not looking at the other part of the equation. What's happened in that decade is, when you're doing a CT image, you've gone from looking at 200 slices per image to 2,000 slices per image. So the workflow increases dramatically when technology advances. So you've got to look at both sides of the equation, have a balanced view, and I thought it was quite an effective anecdote from Sam.
Let's dive into some stock specifics now with our buy, hold, sell segment, starting with stocks that delivered big surprises to the upside or downside. First one, Hub24 delivered on the upside. Buy, hold or sell, Dushko?
That's definitely a buy, coming through with a thesis in terms of operating leverage. So $20 billion of net flows, up to $140 billion plus on the platform in terms of funds under administration. 350 basis points of margin expansion, very impressive, 60% EPS growth. And doing all of that whilst investing in their business. Very sort of passionate and capable management team, continuing to invest in their product and service their clients, yet able to deliver that kind of operating leverage just because of the scale that they're at, and in a really good position to keep winning net flow from the incumbent platforms, plus some of the big super funds as the retirement phase kicks in, and people are leaving with reasonable sized balances that need financial advice.
What about for you, David?
Oh, it's a buy for sure, and I think that last point that Dushko just touched on is just an additional tailwind that's actually going to be probably the strongest, I think, coming through over the next 3 years. And that is, we thought the accumulation to decumulation phase for the industry superannuation funds was probably an early 2030s event. I think it's a here and now event. They're not offering enough advice and support to those superannuants coming into their retirement phase. So I expect that trend to accelerate. You take the money out of your industry superannuation fund, give it to your advisor, get some proper advice and set you up for your life in retirement. So that money will find a home on these platforms, and we think Hub is best positioned to benefit from that.
All right, AGL Energy delivered on the upside. Is it a buy, hold or sell, David?
I'm going with a hold. Look, a good result, solid first half. Electricity margins are strong, but they do have to continually invest to replace old energy, essentially with new energy. It does have a place in a portfolio for sure, creates some good ballast. But at this point in time, we're just seeing too many other opportunities out there in the market that we think have more attractive risk-return profiles at this stage.
Dushko, agree?
Yeah, I actually agree with David in the sense that there's a position for these stocks in the portfolio, but for us it's a sell. The reason it's a sell is, we prefer Origin. We prefer Origin because it's got a better balance sheet. It's got a slightly gentler transition to decarbonisation, so therefore less execution risk. And then back on AGL, I can't say too much against it actually. It's pretty solid EBITDA, just over $1 billion, which was flat. NPAT went backwards a little bit because the depreciation charge was up as they've invested in some assets, but really good customer margins, and some of those battery assets are starting to deliver earnings. So doing a fine job, but in a pair trade, it's a sell.
We've mentioned this one, Zipco. Dushko, buy, hold or sell?
It's definitely not a hold. So we're leading up to a binary outcome here. I'm going to tilt to risky buy, and it's all about risk. Literally, when you look at their loss rates in the US a year ago, they were at the low 1% range. They bumped up to 1.75% in this result, and they're guiding to 1.75 to 2% in the second half. And it's all because they've introduced their Pay in 8 product. Generally been a Pay in 4 product in the US. Pay in 8 product has attracted more losses. Management's claiming credit quality hasn't deteriorated. Market's getting skeptical about that. One of the issues is that the revenue yield hasn't changed. It's still 7%, so you haven't got a kick in revenue yield for the extra risk you're taking. And the market's sort of scratching their head on whether the business model works, with Pay in 8 being 20% of the book now, and getting a net transaction margin above 3%. Now they're saying they need to do that to generate top line, and here's the bull point: top line's impressive, growing north of 40%. Tilting on the side of buy, because if you can keep growing at that clip and generate a profit, the market will reward you, and especially at this new discounted share price we're facing now.
David, you hold it, right?
I do. I felt it.
So must be a buy then, right?
It is. Look, I think what we all underestimated was that shift in product mix and the mechanics and the mathematics behind that around the bad debt profile. We do think that as the Pay in 8 product starts to season, we'll start to see more normalised trends in the BDD profile. There are new products coming to market as well. The Pay in 2 product is coming, so I think that opens up new parts of the market, particularly around utilities and other types of products where you can pay within a month but split the payment. We do think that should ultimately have a little bit of a reversing impact on that BDD profile as well. We do think they are in still pretty good shape. I mean, they are still buying back stock, which probably indicates that the company and management, the board, are still very confident in their ability to continue to fund the growth that they're achieving at the moment. And as Dushko pointed out, TTV growth of over 40% in the US is pretty impressive. They probably just grew a little bit too fast in that product over a short space of time. But we certainly don't think the model is broken, and we think multiples now are quite attractive. You're going to get 30% earnings growth, we think, over the next couple of years, so it's a buy.
Another big talking point in terms of a stock, Medicus. Buy, hold or sell, David?
Well, at these levels, it's a buy. It's a terrific business. It's so unique in so many ways. 80% EBITDA margins. We just think there's a very long runway still to go with contract wins. Contract renewals are almost the same size as a new contract win these days. So multiples always been elevated. Yes, it's come back a little bit. AI fears, I think, are providing an entry point. It's a buy.
Dushko?
Yes, I'd agree with David. It's a buy. Revenue growth 28%, EPS growth 30%. It's a couple percentage points shy of analyst forecasts. I don't think it's a big deal in the scheme of things. It all related to the rollout of their biggest ever contract win, which was Trinity Health. That's a 10-year, 330 million AUD contract. And whether it starts in 1 month or 1 quarter, earlier or later, will make no difference to the valuation of this business. It's a 100 hospital system client, and the rollout is determined on the timeline of the client rather than Pro Medicus' ability to implement, which is pretty instantaneous and one of their competitive advantages. So all in all, a bit of noise and a great buying opportunity with the AI sell-off, just reinforcing the point that the co-founders have also topped up their holdings this week and think that's pretty attractively priced, as do we.
So let's move on to stocks that delivered a strong result that flew under the radar. First, JB Hi-Fi. Buy, hold or sell, Dushko?
Buy, and it's had a very big share price correction over the last 6 months. So whatever the market's fearing is well and truly in the share price. It's delivered really strong sales and EPS growth of 7%, good comp growth of mid-single digits. New Zealand much stronger off a low base. I think the only thing the market was slightly concerned about on the day was January sales had slowed to 2.4% in terms of comp sales growth. Again, it just highlights that sales periods are the key periods in terms of generating returns. Very competent management team, 208 stores, JB Australia, 107 good guys. I think the business is well set and well managed, and so it's a buy.
What say you, David?
Hold for me. Not quite as positive as Dushko on this one. Do see that the macro is a little bit of an overhang for this stock at the moment. We saw the inflation print a day or so ago now, probably leading to potentially another interest rate rise. We have seen consecutive quarters of decelerating comp growth. The comps only get harder as we get into 30 June as well. So we think on balance the earnings risks are slightly skewed to the downside. But I do take the point from Dushko. It's a high quality management team. It's probably the best retailer in the country. But at current levels, despite the pullback, we think the earnings risks probably warrant a hold at this stage.
Next stock, Goodman Group. Buy, hold or sell, David?
Oh, that's a buy. Look, they are going through a transition from an industrial developer essentially to data centre. That data centre market and environment is constantly evolving and moving pretty rapidly. So look, I think it has probably taken them a little bit longer to get to where they want to get to, but ultimately they've continued to deliver double-digit earnings growth throughout this transition. It's an exceptionally well-run business. The balance sheet is pristine. It's self-funding in data centre world, which is quite rare, and we think that earnings will start to accelerate as that data centre pipeline starts to hit. So that's a buy from us.
Agree, Dushko?
Yeah, I do agree, actually. David made some great points there, especially the balance sheet. I think that capital raising they did last year put them in the position where they're not dependent on client funding, and then they can make better choices in terms of tenants for their data centres that they're rolling out. Look, data centres at the end of the day in terms of delivery are all about power. They've got a 6 gigawatt portfolio across 16 cities in terms of power bank. and they've secured 3.6 gigawatts of that. So very impressive, ahead of their competitors, and they're selling what's most in demand at the moment. So that's a buy.
We asked our guests to bring along a stock that they think delivered a strong result that flew under the radar. We'll kick it back to you, Dushko. What's your pick?
Look, I'm going to pick Fisher and Paykel. It's a March year end, so it didn't actually have a result, but it did sneak in its third earnings upgrade for the year. The very understated Kiwis over there just keep pumping out great results. $2.3 billion of revenue, upgraded their NPAT guidance to 450 to 470 million, up from 410 to 460. I love these guys. There are no excuses kind of business. It's all being driven by the nasal high flow product, and they've delivered this result even though the flu season in the US hasn't been strong, even though tariffs have messed around with production and margins. So they've just found more efficiencies within their business. And then even though the currency's against them in terms of New Zealand dollar appreciation. So always under the radar, but very consistent in terms of what they deliver. And now that we're past the pull forward of COVID, we're back to really consistent delivery of top line and bottom line.
What's your choice, David?
I'm going to go with Min Resources. I thought it was a terrific result. They beat on essentially every level across every division. It was just really nice, clean set of numbers after certainly a period of turmoil for the business. Look, we're not massively bullish on iron ore, but we do think the iron ore price will hang around current levels. Volumes are ramping up at Onslow. Disruption issues, I think, are slightly behind them. They've got the lithium optionality coming through. But what also gets overlooked, I think, is mining services business. That's in really good shape. We do think there's extra growth optionality in mining services for them to service other mines as well. So that's something to keep an eye out on for the future. And it is deleveraging, we think, rather rapidly. So Min Resources is one for me.
All right, let's move on to stocks that delivered the best outlook moving into 2026 and beyond. A2 Milk. David. Buy, hold or sell?
It's a buy. It's in terrific shape, I think, despite the macro concerns around China. So did move the other day around lower birth rate in China, but at the same time, marriages are actually up double digit in China. So marriages lead births by about 12 months, coincidentally, maybe not coincidentally. And so we do see the birth rate having somewhat bottomed at this stage. They're continuing to take share, though, in that market. Their competitors are under a little bit of pressure with some contamination issues. They've reconfigured their supply chain, which is now behind them. So we have started to see all those factors play into revised higher revenue growth, and we do now think we're in a period where EBIT growth and EBIT margins will expand as well. So it's a buy. For you, Dushko?
Yeah, it pains me to say it's a sell. Agree with the points that David made, and credit to the management team who's done an unbelievable job of growing revenues 7% and profits as well in a declining market. And that's been driven by increased share in terms of English label versus China label in China, and just great execution by the management team. Unfortunately for us, and I think quite often you make money on stocks on a 2 to 3 year view rather than a 1 year view, and I think the 1 year is pretty locked in, but the 2 to 3 year view, with births declining from 9.5 million to 7.9 million, 17% down, I just think demographics is against them.
Okay, the next one, Charter Hall. Buy, hold or sell? Dushko?
That's a buy. They've increased their FUM to over $90 billion, added $6 billion onto the platform. Market was a little bit disappointed with some lower EBITDA margin in that funds management business, but it was just some variable costs because of good performance, and I think that normalises into the second half and beyond, delivering 20-30% EPS growth this year and very solid double-digit earnings growth in the couple of years thereafter. And I think it's a great management team. CEO's back on fire, and it's a buy for us.
David, agree?
I do. It's a buy. Charter Hall, I think what is potentially slightly underappreciated with Charter Hall at the moment is their market positioning and the moat that they've now built around their business. If you look at other real estate fund management platforms, they're in disarray, essentially. Lendlease has got some well-documented issues. Dexus seems to be arguing with its capital partners, if you like. HMC has had some issues as well in the funds management space. So their track record, their ability to give product to their clients is unrivaled, I think. And that puts them in an exceptionally strong position to attract capital and to deploy it. So we think the outlook for the next 2 to 3 years looks really robust, even if interest rates stay at these levels.
Okay, well, again, we asked our guests to bring a stock that they believe delivered the best outlook for 2026 and beyond. What's yours, David?
I'm going to go with Pilbara, PLS. I'm going to stick with the resources thematic here. We continue to see that lithium market move from an oversupply market, as I mentioned earlier, into deficit as we go through the course of the year. Demand's never been an issue with lithium, in my view. EV adoption continues to be very strong. US gets some headlines around lower EV adoption, but that's not really the story. We've got other Southeast Asian markets growing very, very strongly. The electrification of things essentially is now moving into bus fleets, if you like. Ships are now turning, potentially shifting that way as well. And then overlaid on top of that is the very fast-growing battery energy storage that is soaking up a lot of lithium as well. So demand looks really, really good, but it's really the supply side of things that has shifted quite a bit. We saw announcements last night from Zimbabwe around locking up some of their lithium supply. So the African supply story hasn't really eventuated. We've got the Chinese looking to be more rational in the market as well. And certainly the Australian producers have been more disciplined as well. So we see Pilbara in a very, very strong position, in a position to expand their output. They've got lower costs. They won't need the same level of lithium prices to absolutely knock it out of the park. So Pilbara for mine.
Dushko?
Well, I'm sticking with healthcare, just as David stuck with resources. I think put us together and we've got a pretty good barbell here. My pick is ResMed. Delivered another quarterly result that had an upgrade in it. Really strong revenue growth of 11%, EPS growth 16%. They've got that gross margin back up to between 62 and 63%. Huge recovery off the COVID impaired period. Delivering really strongly against the panic that happened 2 years ago, as opposed to the software panic we're in now. The GLP-1 drugs were going to take away demand. In fact, we now know over 2 million people are using both GLP-1 drugs and are on a CPAP machine. Those patients are actually more compliant, and what ResMed is finding is that the awareness from the GLP-1 drugs is actually increasing the funnel in terms of patients being diagnosed. And the biggest thing about obstructive sleep apnea is so many people have it and it's undiagnosed. So net, it's actually been a positive rather than the end of the business model. And I think it's the repricing of ResMed back to its former share price after it almost halved in 6 weeks 2 years ago when that scare happened is a really good model for what I think is likely in software stocks as well. Once the hype disappears and the numbers are delivered unabated, we'll get a repricing.
Well, that's a wrap. I hope you enjoyed that deep dive into some of the big results and key themes from the reporting season. If you enjoyed that episode of Buy, Hold, Sell, make sure you check out the Livewire YouTube channel for regular episodes.